Hi, I want to talk about the pricing strategy, but before we get to what is pricing strategy? Pricing strategy refers to the method used by a business to determine the selling price of its product or services. It is important business decision because the price affects sales, profit, and customer demand. Companies choose different pricing strategy depending on their objective, market condition, and target customer. Therefore, selecting the right pricing strategy helps a business remain competitive and achieve the long-term success. Okay, let's talk about the types of pricing strategy. First, we have markup strategy. According to the article, markup pricing is one of the most commonly used pricing strategy. It involves setting the selling price by adding profit margin to the production cost. This type of the pricing is commonly used in industry such as construction and manufacturing, where it can be difficult to access market value. The goal of this cost-plus pricing is to ensure that production and delivery costs are covered while providing a reasonable profit level. Second, we have penetration pricing. Penetration pricing is a strategy that involves setting a low initial price for a product or service, typically before it's launched, to attract customers quickly and gain market share. Companies often use this strategy to gain an advantage over their competitors by introducing their products or services at lower cost than the competition. The goal of penetration is to quickly generate sales, volume, and revenue, which can then be used to offset production costs and increase profitability. Third, we have competition-based pricing. Competition-based pricing is a strategy where company sets its price by differing from competitors' price. A business may choose to set a similar price or lower price or even a higher price depending on their objective and market position. The article also states that this strategy is commonly used in competitive, where products have a very little difference from one another. I think this strategy help the business competitive, but the business should consider about the cost and customer value when setting the price. Next, we have price skimming. Price skimming is a strategy in which goods or services are sold at a high price initially and then the price gradually decreases over the time. Companies typically use this strategy when launching a new product, as it helps to maximize profit in the early stage of the product life cycle. Price skimming targets for the customers that are willing to pay premium for the new products. Lastly, we have perceived value pricing. Based on the article, perceived value pricing is a strategy where the price is determined by how much customers believe the product has. These include both tangible factors like usefulness and product features, as well as intangible factors such as brand reputation and quality. The article explains that this strategy is commonly used in luxury brands. I think, in my opinion, this approach works well for the premium products because customers are more influenced by the brand value than the production cost.
Hi and Assalamualaikum. My name is Muhammad Adam Akil bin Anwar, metric number 313456. On my slide, I'll be explaining about advantages of pricing strategy. The first advantage of pricing strategy is revenue and profit maximization. A good pricing strategy helps companies generate higher revenue and maximize profit. By setting the correct price, businesses can ensure that selling price cover operating costs while still producing acceptable returns. For example, company may use premium pricing when offering high-quality products to customers who are willing to pay more. Other companies may set lower price to increase sales volume and earn profit through larger customer purchases. Therefore, pricing decision is directly influence a company's financial performance and sustainability. The second advantage is market penetration and customer acquisition. Pricing strategy plays an important role in attracting customers and increasing market share. Customers often compare price before making purchasing decision, so businesses must offer prices that match customer expectation. Some companies use lower introductory price or promotional pricing to encourage customers to try products. This strategy helps attract new customers and increase sales. Over time, satisfied customers may continue purchasing, helping businesses expand their customer base and strengthen their market presence. The third advantage is competitive positioning. In today's competitive business environment, companies must continuously respond to changing market conditions. Pricing strategy help businesses remain competitive by offering prices that provide value to customers while maintaining profitability. For example, a company may reduce price to respond to competitors or introduce premium pricing to differentiate itself in the market. A strong pricing strategies allow business to stand out and maintain a competitive advantage. The fourth advantage is customer value creation. Customers usually evaluate whether the price they pay matches the value they receive. Therefore, businesses must ensure that pricing reflects product quality and customer expectation. When customers believe they receive good value for money, certification increase and repeat purchase become more likely. This relationship between price and perceived value is important for building customer loyalty and maintaining long-term success. The final advantage is supporting strategic businesses decision. Pricing strategies support many business goals such as increasing sales, improving profitability, entering new market, and strengthening brand position. Different pricing approaches can help businesses achieve different objectives depending on their market and overall strategy. In conclusion, pricing strategy provides several important advantages, including maximize revenue and profit, attracting customer, improving competitiveness, creating customer value, and supporting business growth. These benefits show that pricing is not only about setting a selling price, but also creating long-term business success.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Aisyah Farhana binti Hussein, and I would like to present about the impact of pricing strategy. Pricing strategy plays a crucial role in determining the success of a business. It affects not only profits but also customer behavior and companies' ability to compete in the market. Pricing strategy has a direct impact on a company's profitability because it determines the amount of revenue generated from sales. By setting appropriate prices, businesses can maximize profits while maintaining customer demand. Different pricing approach may produce different financial outcomes, making pricing one of the most important decisions for business success. Second, pricing strategy strongly influences consumer buying behavior because customers often compare prices before making purchase. Consumers are more likely to buy products that offer good value for money, while high prices may encourage them to switch to competitors. As a result, pricing affects customers' purchasing decision, preference, and overall satisfaction. Lastly, pricing strategy is also important for improving a company's competitiveness in the market. According to Zhao et al. In 2022, differential pricing helps store brands increase profits, attract more customers, and strengthen their competitive positions against national brands. The study suggests that an effective pricing strategy can provide business with a competitive advantage and support long-term growth. To sum up, pricing strategy affects profitability, consumer buying behavior, and brand competitiveness. Therefore, businesses should carefully choose their pricing strategy to attract customers, increase profit, and maintain a strong position in the market.
My name is Muhammad Shakib Muhammad Sabri, matric number 314127. On this slide, I will explain the factors that affect pricing decision. First is cost structure. Business need to think about production costs, operating costs, and profit they want to earn before setting a price. Second is customer perceived value. Customer will pay based on how useful and valuable they think the product is. Third is a market demands and price sensitivity. Business look at customer demand and how customer react to price changes. Fourth is the competitive environments. Companies compare their price with competitors to stay attractive in the market. The fifth factor is discounting and promotions. Discount and promotion can increase sales, but they should support business goals. The sixth factor is business objective. Pricing depends on what the business want to achieve, such as making more profits, attracting customers, or growing the markets. The seventh factor is external economic factors. Things like inflation, customer spending power, and economic condition can affect pricing. In conclusion, business needs to balance cost, customer value, competition, and market condition to make good pricing decisions. By considering these factors, business can set price that attract customers and support long-term success.
Okay, first, we have to know why we must measure the success of our pricing strategies. Setting a new price is only the first half of the work. The real test is seeing if that price is actually delivers the result we plan for. According to McKinsey, companies that take the time to actively manage and measure their pricing see a 2% to 7% increase in profit margin. If we don't measure, we might leave money on the table or hurt our position in the market without even knowing it. By tracking our progress, we can validate our assumption, see how customers are reacting, and make data-driven changes when we need to. A study by PwC showed that 37% of companies fail to track pricing correctly, which means they are missed out on big opportunity to improve. Okay, next, for the first metric, revenue and profit margin. The most direct way to see if our pricing work is by looking at the bottom line. First, we look at our revenue growth rate by comparing what we earned before and after the change. Next, we look at profit margin changes to see how the price is affecting our overall profitability. This is important because Simon-Kucher and partners found that just a 1% improvement in price can lead to an 11% increase in profit for many businesses. If we are running a subscription-based model, we must also track average revenue per user to ensure we are getting the right amount of value from every customer. Okay, for the second metric, customer acquisition and retention. Price has a massive impact on how customers behave. We need to monitor our customer acquisition rate to make sure new people are still signing up at a healthy pace. Just as important is the churn rate, which tell us if we are keeping our current customer after the price change. Forrester research shows that a poorly handled pricing strategy can increase churn rate by as much as 15%. If we use tiered pricing, we should watch upgrade and downgrade patterns to see if people are moving toward the value they need. Finally, we look at customer lifetime value to see if the new price is helping or hurting the long-term value of our customer base. Okay, for the third metric, market position and competition. Pricing does not happen in a vacuum. So we must look at our competitor. We should track market share changes to see if we are gaining or losing ground. It is also helpful to look at win or lose rates to see if we are losing more deals to competitor because of our price. We use competitive price indexing to compare our price against other options. Over time, Bain and company found that companies that check their pricing against competitors regularly see 25% higher return than those that only look at their own internal data. Okay, for the fourth metric, price elasticity and demand. We need to understand how sensitive our customers are to the price changes. This means looking at volume changes to see how the quantity we sell changes when the price moves. We can calculate a price elasticity coefficient to give us a hard number on that sensitivity. Another sign to watch is discount frequency. If our salespeople are suddenly giving much larger or more frequent discount to close deals, it might mean our base price is set too high for the market. Company that actively measure this sensitivity achieve 3% to 8% better pricing outcome. Okay, for the fifth metric, customer perception, numbers only tell part of the story. We also need to know what customers are thinking. We track Net Promoter Score trends to see if customer satisfaction has shifted. Value perception surveys are great for finding out if customers feel the price is fair for the value they get. We should also look at social sentiment and sales objection to see if people are complaining more about price than they used to. Research shows that companies with a strong value perception can change 20% to 50% more than competitors who have the same product but communicate their value poorly.